it reported its Q3 earnings. Snehi obviously caught up with the management to understand the fine print a little bit better. Listen into a slice of that.
I just want to understand this 4% volume growth number. It is much better than what the street was estimating, between 2 and 3%. Given that we've seen a decline in the revenue, revenue is in line, pardon me, but a decline in the PAT that's coming, if you don't account for this ice cream business demerger gain that we've seen. Margins have also slipped on a year-on-year basis, although they continue to be on the upper end of your guided range. Could you help us understand what has led to this volume growth of 4%, and does it actually account for the kind of underlying business that we've seen?
So let me pick that up to start with. So first of all, our 4% volume growth is probably the highest in the last 10 to 12 quarters. It's been a very broad-based growth across categories, as you saw, with our USGs in 3 of the categories at 6%. And in home care, we had a mid-single-digit UVG. And there was a price which was taken earlier as a correction, which led to the USG of 3%. So it's a broad-based growth. It's not a growth which is coming from just one category. Coming to, again, your question around the profits, yeah? So again, let me reiterate, because you said revenue decline. Revenue has actually grown by 6%.
It has, yes.
Yeah. On the profit part of it, I think you should look at 3 levels of that, yeah, from the discontinued operations. Number 1 is your EBITDA growth. Our EBITDA growth is 3%. Our margin is 23.3%. The EBITDA margins include a one-time charge which we have taken on account of the gratuity impact of the labor code. And that is around 110 crores. So obviously adjusted for that, if you look at it, an EBITDA margin would have been also close to around 5% growth, yeah, at around 24%. Of course, in the quarter, the A&P has been a little lower in terms of percentage to the revenue, which will get stepped up moving forward. So the quality of the growth has been very good in terms of our EBITDA growth, absolute, that you talk about. The third element coming to the PAT. Again, the PAT has not declined. You have to look at PAT before exceptional item. The PAT before exceptional item actually grew by 1%. So against an EBITDA growth of 3%, a PAT growth of 1% happened because of the lower financial income, which was driven by our capital allocation, which we did, which is spending on acquisitions, which then resulted in the lower investable surplus. So underlying, if you look at it, capital allocation has been towards paying out to shareholders and acquiring brands which are in the category that are growing. And if you look at underlying EBITDA, that has grown by 3%, but that had a one-time charge. So that's the right way to look at the results of the discontinued operations.
Okay. Priya, my question to you.